What if I told you the money in your bank account isn't really there? Not because the bank stole it, not because anything illegal happened, but because the system was designed this way. Legally, the moment you deposit money, it stops being yours. That sounds dramatic, so let's slow down. This isn't a conspiracy. It's not a secret. And it's definitely not new. Right now, somewhere on a screen, you see a number. Your balance, your savings, your safety net. That number feels solid because you trust it, but that trust is doing almost all the work. And once you understand what it's built on, you'll never look at your bank account the same way again. From childhood, we're taught a very simple story about money. You work, you earn, you save. Banks protect it. That belief is emotional, not legal. The story feels intuitive. Banks have buildings, vaults, locks, security guards. So the assumption feels obvious. My money is stored safely until I need it. For centuries, that assumption was mostly true. Banks really were places where money slept. Today, it never sleeps. Modern banks don't work like warehouses. They work like engines. And engines don't store energy. They use it to create more. This is where the story quietly breaks. Here's the first thing most people never realize. When you deposit money in a bank, it no longer belongs to you in the way you think. Legally, you are not storing money. You are lending it to the bank. Your bank balance is legally an IOU. That's not philosophy. That's contract law. And you agreed to it even if you didn't realize it. Your money is not sitting in a vault with your name on it. It's a promise the bank agrees to honor when you ask for it. And that promise works perfectly, as long as not everyone asks at the same time. This isn't a trick. It's design. And the system depends on most people never needing to question it. Now we reach the heart of the system. Fractional reserve banking. The name sounds technical, so people tune out. But the idea itself is simple. Banks are allowed to lend out most of the money deposited with them. They keep only a fraction in reserve. Historically, that fraction might be 10%, sometimes less. In modern systems, sometimes close to zero. So, if you deposit $1,000, the bank might keep $100 and lend out $900. Here's the part most people miss. That $900 doesn't disappear from your account. You still see $1,000. The borrower now also has money to spend. One original deposit, two separate balances. If this happened in any other industry, it would be called duplication. But in banking, it's normal. It's regulated. It's legal. And it scales. And here's the uncomfortable question. If everyone believes they own money that doesn't physically exist, what happens when confidence breaks? This is the moment most people miss. Because once you understand this part, you understand everything else. When a bank issues a loan, it does not take existing money and hand it over. Instead, it creates a new deposit. This is why economists say, loans create money. Repayments destroy money. Most money in the modern economy is not printed by governments. It's created by private banks. Every time someone signs a loan, a mortgage, a business loan, a credit card, money is born as debt. That's not a theory. That's accounting. Imagine a restaurant with 10 tables. The owner knows from experience that not everyone shows up at the same time, so they accept 20 reservations. Most nights, it works perfectly. People arrive at different times. Tables turn over. No one complains. But if everyone shows up at once, the system collapses. Banks work the same way. They don't fail when one customer withdraws money. They fail when everyone shows up. This is why governments fear bank runs more than almost anything else. Not because banks are empty, but because the system cannot survive. Everyone demanding honesty at the same moment. If everyone asks for their money at once, the math breaks. That's why during crises, withdrawals get limited bark. Governments step in. Central banks inject liquidity, not primarily to protect individual depositors, but to protect confidence. And when withdrawals are frozen, it's not hedge funds waiting. It's people who need rent money, payroll money, Grocery money. That's why bank runs spread faster than logic. Central banks exist to stabilize this system. They act as lenders of last resort. When banks struggle, central banks create new money to support them. This doesn't mean collapse is inevitable. It means stability is managed. And management always has a cost. The cost just isn't labeled clearly. Inflation is that cost. It's not an accident. It's the pressure release valve. When more money exists than goods and services, prices rise. No vote. No announcement. Your purchasing power shrinks quietly, gradually, legally. You don't notice it day to day. You notice it when the same salary buys less life. This system strongly favors borrowers, asset owners leavened, financial institutions. It quietly disadvantages savers, fixed income workers now, people who avoid debt no. That's not a moral judgment. It's incentive design. And incentives decide outcomes. This is why people say the system feels rigged. But it isn't rigged. It's optimized. Optimized for growth. Optimized for leverage. Optimized for risk takers, not for stability. Legally? No. Psychologically? It relies on misunderstanding. Most people think money is stored. In reality, it's circulating promises. Misunderstanding isn't an accident, it's convenient. And promises feel safe until they aren't. This isn't taught because it's abstract, because it challenges authority, because it makes people uncomfortable. But understanding the system doesn't weaken it. It strengthens your position inside it. This video isn't telling you to panic. It's telling you to see clearly. Once you understand how money works, you stop blaming yourself. You understand inflation. You see risk differently. Knowledge doesn't remove uncertainty. It removes confusion. Modern civilization runs on trust. Banks don't steal. They operate within incentives. And incentives shape the world we live in. So the real question isn't, is this a legal scam? The real question is, if money is created this way, how should you play the game? Because the rules aren't changing, but your understanding can. And if this changed how you see money, you'll want the next video. Because this system quietly rewards people who understand it early.